How many times you've been bored, let's say on a Saturday, you're flipping through. I use Flipboard. I don't know what you use, but you're flipping and you're reading headlines and you see this headline and you think, oh boy. Oh boy. And you think you know what the article's going to be about. And then, to misquote Princess Bride, classic movie, by the way, Princess Bride, that doesn't end up meaning what you think it means. Live from the 3-room garage apartment above Uncle Jack's garage. Hey there, everybody. I'm Joe Saul-Sehy, Average Joe Money on Twitter. Welcome to Money in the Morning. This is the show where we take not one, but two headlines ripped from the financial press. We don't only read them, which is what some shows do. How boring is that? Instead, live, we not only read them, but we also talk about what those might mean for your wallet. Money in the Morning is this week brought to you by our Stacky Benjamins tour. We got one date left, kids. If you're going to come see the show, you better go to Detroit. Now, I'll tell you, the bar is high. When I say come to Detroit, I understand that might not happen for some of you, but let me tell you what happened. When we were in Kansas City, Jay flew from Oregon to Kansas City. Jay becomes our favorite fan. So if you want to be our favorite fan, head to stackybenjamins.com/tour. And you know, if we meant anything to you, you just pick up wherever you are and fly to Detroit and see our show. Our show goes off on October 24th. We're at Go Comedy Improv Theater in fabulous Ferndale, Michigan. That's 9 miles north of Detroit on 9 Mile Road. And great little theater. And this theater, we have a chance of selling out. So if you're getting tickets, if you're waiting to buy them at the door, we have a shot at selling this place out. So you might want to get them online. stackybenjamins.com/tour for more. All right. Enough about the tour. Can't wait for that to happen. But today I can't wait for these headlines. So Laura, why don't you kick this thing off?
And now your first Money in the Morning headline.
The first headline that I read that I went, oh boy, what could possibly go wrong with this? And then I found out it was a little different than I thought, was this one. This comes to us from CNBC and is courtesy of Diana Olick wrote this. Thousands line up for zero down payment subprime mortgages. What could go wrong there, huh? It's funny. A lot of people had no idea what a subprime mortgage was until 2008, right? No idea. I remember, I've been a financial planner since 1993. I remember in the early 2000s, really starting to look up subprime as things started to bubble, maybe 2002, 2003, and then getting comfortable with that. And by 2005, being fairly comfortable looking at those numbers. And 2007 hit, and oh, Nelly, things changed. And now I think everybody knows subprime. So headline again, thousands line up for zero down payment subprime mortgage. No money down, subprime. Madeline Aldador lost her home to foreclosure during the subprime mortgage crisis, this piece reads. But this week, she was first in line at a 4-day event in Miami where borrowers with poor credit were offered no down payment, low interest rate loans. Quote, I left home. It was about 4 a.m. She laughed. I'm ready to purchase a home. The event's one of several being held in cities across America this year, run by the nonprofit Boston-based brokerage Neighborhood Assistance Corporation of America, or NACA. Quote, it's a national disgrace about the low amount of home ownerships, mortgages for low and moderate income people and for minority home buyers, said Bruce Mark, CEO of NACA. In the loans that we've originated the past 6 years, zero foreclosures. Let's go through this. This is when this piece hit me. In the loans we've originated in the past 6 years, zero foreclosures. Marks and NACA were front and center during the subprime mortgage crisis, holding mass mortgage modification events across the country with banks and servicers. Bank of America was there then, and the bank is with NACA now. backing the program with $10 billion in mortgage commitments. Quote, "It's total upside," said AJ Barkley, Senior Vice President of Consumer Lending at Bank of America. "We've seen significant wins in this partnership. Just to be clear, when we get these loans with all the heavy lifting here, we're over a 90% approval, meaning 90% of the people who go through this program, we actually underwrite the loans. 90%. Borrowers can have low credit scores, but have to go through an education session about the program and submit all necessary documents from income statements to phone bills. Then they go through counseling to understand their monthly budget and ensure they can afford the mortgage payment. The loans are 15 or 30-year fixed with interest rates below market at about 4.5%. Quote, "That's what's going to help people who've been locked out of homeownership to really become homeowners and to build wealth," said Marks. Critics of the program argue that with no down payment, no skin in the game, these borrowers have no reason not to walk away should their homes lose value. That's what's happened during the financial crisis. The difference in this program is that the borrowers cannot be investors. In order to get the loan, they have to live in the home. Quote, "People have skin in the game in a real way," said Marks. "The people that walk away are higher income people who look to homeownership as an investment, just like buying stocks and bonds. Working people look at their investment in homeownership for their family, for their neighborhood, for themselves." Quentin Carswell is a first-time home buyer who tried to get a loan from a traditional bank. Quote, "They tell you they have a lot of first-time home buyer programs, and then once you get there, they tell you these outrageous numbers. It's hard for normal class people to afford to get into a house and, put $20,000, $30,000 up for down payment. That's a lot of money." I don't want to go into whether homeownership is a right or not, which, reading a few of these comments in this piece, some people seem to allude to that. I want to talk about the other piece of this. The piece of this I find exciting isn't the should people own a home or not, right? Because I think that's an overblown argument. I think the big cool thing here, zero people defaulting on their mortgage after they go through this program, and not over a short period of time. This program's been going on for a number of years. Zero defaults. And why? Education. And I think it's funny because we kind of scoff at education, and yet you are who you surround yourself with. I'm sure if you listen to this show, this probably isn't the only podcast you listen to about money, and you're surrounding yourself with these ideas about money. And whether you're just through osmosis picking up a few things like our friends over at the Stacky Benjamin show do, or you're in one of the shows like our friend Paula Pants where they try to dive deeper on topics, you're surrounding yourself with this stuff. And when you surround people with financial detail, it's not that hard, right? I mean, and it actually gets more fun once you know the lingo, which is what kind of makes me mad too. When we use terms like 401k, Roth IRA, backdoor Roth, mega backdoor Roth IRA, baby, all these crazy terms that we use, HSA, FSA, we use all this lingo, and it's this big barrier to entry. But then when we sit down with people and we talk about what's your budget and can you actually afford this house? And you're right, they do have total skin in the game. If you're going to live in that house and your family's going to live there, you don't want to default on that mortgage. In fact, it's funny, by the way, before the subprime issue hit and blew up, I read a statistic about people getting kicked out of their houses. And most people thought and still think the people that get kicked out of their houses, except really around the 2007-2008 crisis, which enveloped a lot of good people working very hard. But a lot of people think that people are deadbeats when they do that. The number one reason people lose their house, disability. Disability was, at that time, the number one reason. I haven't seen that study in a number of years. I think it was 2006 that I saw that study. But I'm sure disability is still up there. Not deadbeats. People that lose their job, lose their source of income, and lose it. People want to keep their house. And so some education on top. I love this. Education wins the day again. I think it's super exciting. This article wasn't at all what I thought it was going to be. I was like, oh, some well-meaning nonprofit saying everybody deserves a house. Not the case at all. Pretty cool. And maybe they do. But I mean, maybe they do think that. There are some of those undertones here in this piece. Once again, I'm not worried about that. I'm worried about the education piece. Education for the win. Let's say hi to our friends hanging out with us this fine morning as we record this live on Facebook. By the way, if you want to be part of our live Facebook audience, head to facebook.com/iStackBenjamins. And we do these at random time. Today, we actually announced that we were going to be doing this ahead of time, which is crazy for us. Usually we just kind of show up and start talking headlines. Tim is here. Tim says, what does zero down on anything? Why does zero down on anything attract people? That's just not smart, in my opinion. Get whatever it is you're buying paid off ASAP. Tim is on the other side of this argument. And by other side, I don't mean that he thinks people getting a house is bad. He's already made the connection to what we talked about a couple days ago on the show, which is debt. You're a slave to this debt. So people want to get into this house. That's the whole discussion that, why are people so excited about getting into debt? Lisa's here. Hey, Lisa from the Mad Money Monster blog. Lisa said, I did read they were low interest rate mortgages. I assume that meant they weren't also variable. Yeah, low interest rate, fixed rate mortgages, and people are actually paying them off. Rob's here. Rob says, sounds like the Habitat for Humanity program. It is way neater than I thought it was. I seriously had the same old eye roll I see some people here had. Karen says education part is the key and low interest rate, says Patrick. And Kevin says, wait, there's other podcasts about money. I shouldn't have said that. Actually, go listen to some of these there's some fantastic money podcasts out there. Karen is here. Fixed rate too. Variable interest on mortgage scares me. Yeah, there is fixed rate. Than is here. Hey, Than. Subprime mortgages. Dear God, why again? They're also called no prime loans. Isn't that bad? The answer is yes. But if you just got here, Than, go back to the beginning of this. Take a look at this piece. It is zero defaults. Zero defaults. Education winning the day again. Not at all what I expected from that piece. I'm pleasantly surprised. Let's put it that way. Our second piece comes to us from Market Watch, and this is written by Tanya Hester. Tanya, by the way, won Blog of the Year in the Plutus Awards this year for her blog, Our Next Life. And great blog to go read. Tanya's focusing on early retirees and the stock market. We've had I don't know if you noticed this, but the stock market's bounced around slightly, just a little, right? Just, I don't know. You might have noticed there might've been a headline, might've been a little panic in online forums. Yeah. Tanya writes, 7 things early retirees can do when the stock market turns on them. And I know of Tanya, and I know the way Tanya writes. But once again, I went, and this isn't me dissing Tanya. This is me looking at that headline. I'll read it to you again. 7 things early retirees can do when the stock market turns on them. I went, oh boy. Oh boy. This is not going to be good. Let's read. We've had a bumpy ride with the stock markets, and after the historically long bull market we've been enjoying over the past decade, many are wondering if this is just a short-term market rout or the beginning of a bigger and more persistent global recession. The only way to know is to wait and see, but we can look to past recessions for some sense of what to expect. The 2008 financial crisis is the most recent recession most of us have witnessed, and in it, the Dow Jones Industrial Average lost a full 50% in 17 months, with the S&P 500 diving 56%. While that was scary to live through for those who were invested in the markets at the time, the good news is that historically, the average time from market trough to new market peak in bear markets is 684 days, about 22 and a half months, a number that's likely skewed higher by the especially long 1974 to 82 recession. In market corrections, dips between 10 and 20%. The average correction is 107 days, just over 3 months. Those timeframes don't account for inflation, meaning the time between a crash and returning to equal spending power is slightly longer. So if the current volatility follows historical patterns, we could expect this bumpy ride to last anywhere from a few months to a few years. For those who retired early or who aspire to, what should you be doing right now? And again, I read those words and I went, oh boy, here it comes. And then she writes, number 1, do nothing. Don't panic. Don't freak out. If you can help it, don't even look at your account balances. Unless you need to sell shares right now, your portfolio losses are only losses on paper. And if you're investing for the long term as you should be, dips are meaningless. And whatever you do, don't start selling shares or reallocating investments in response to market volatility, an approach that's virtually guaranteed to lose you money in the long run, while buy and hold investing is proven to make you money over time. I'm going to parse this one out a little bit as Tanya goes through her different things. I love this idea of doing nothing. I also love the idea of not looking at your statement if you don't need the money right now. I will say this, if you have individual stocks, individual positions, some are going down for different reasons than others. If you have individual stocks, you still have to look at those individual positions. As an example, we have a little problem going on with Sears right now. So if you own Sears stock, then it might be a different deal. So individual stocks, you always have to look, which is why we tell most people, stick with exchange traded funds, stick with mutual funds. Don't get involved in the individual stock game, because then you do have to look. And then you start looking at stuff that you probably shouldn't be looking at in the first place. And it can get ugly. That's my thought on number 1. But love number 1. And all of a sudden, instead of, oh boy, I'm going, oh boy, this is pretty good. Number 2, cut spending. If we get into recession territory, it's a good idea to cut your spending so you can stretch your cash cushion as long as possible. Ideally, you have at least 2 years of living expenses saved in cash. Advice for traditional retirees that applies equally to early retirees. Eliminate frivolous spending. DIY everything you can rather than hiring others to provide services to you. Reduce your fuel and utility costs by driving less and keeping your house colder in the winter and warmer in the summer. Defer large purchases until after the market's recovered. If you wish to keep traveling, travel on miles and points and choose cheaper destinations like Southeast Asia instead of Western Europe, or focus on camping around the U.S. instead. Again, all stuff you can control. Great ideas. Make that cash last a little longer. And I love the fact that Tanya's basing this on history. If we're looking at a historical peak to trough of 2 years max historically, then by all means, let's just cut a little bit to see if we can eke out a couple more months and make that cash last a little longer so we don't have to sell. Beautiful. Beautiful advice. Number 3, find additional sources of income. If you've already cut your spending to the bare minimum in order to retire early, you may find it more doable to earn a little extra. Consider ways to earn money with your home, perhaps by renting it out on Airbnb on occasional weekends or taking in a roommate. Consider starting a side hustle that's both fun for you and brings in some additional income. Or talk to old career connections about whether they need some part-time consulting help rather than hiring full-time staff when budgets are tight. I'll tell you what I like about the working part. If you're already financially independent, I still like working, because you see in a lot of the Alzheimer's studies that are out there, a lot of the longevity studies, people that let their brain atrophy are in trouble. Don't do that. And giving yourself some purpose and having this side hustle or all these different ideas that she's talking about, doing something is great. Doing something for money in the case of a downturn, even better. Again, not at all what I expected. Number 4, be judicious about selling shares. The biggest risk to any retiree's portfolio is sequence of returns risk, also known as sequence risk, which occurs if you have several bad stock market years in a row, especially early in your retirement. And the single best way to avoid sequence risk is to avoid selling shares of anything in your portfolio. Do your best to rely on dividends first, as they don't deplete your portfolio. And if you must sell shares, sell bonds first before you tap into stocks. Let's go into that for just a moment. So, market is going down. You've got some funds. There's this measure that you can look up, and you can do this someplace like Morningstar.com. It's called standard deviation. And standard deviation is how much shake, rattle, and roll you've got in your investment, right? So your stock might go up and down a lot. A bond is going to be a much more mellow bounce. If the market's dropping, you want to look for the things with the lowest standard deviation to sell off first if you have to sell those. and then go up standard deviation. You know how like you pay debt, either with if you're using the debt snowball method, the smallest balance, and you're lining them up according to balance, or if you're doing the debt avalanche, you look it up according to interest rate. It's the same thing with selling your positions in a down market. If you got to sell anything, start with the lowest standard deviation and move up to the highest one. And you can find that measure at places like Morningstar for all of your funds. Pretty easy to line those up. Next piece of advice. Don't scrimp on insurance. Though it's tempting when you're tightening the belt to cut all expenses, this is not the time to scale back on health insurance or other protections that limit your total potential cost. If your state allows non-ACA compliant catastrophic plans, you might be tempted to switch away from traditional health insurance to the cheaper option or move to a healthcare sharing ministry. But that penny pinching could backfire if you have an accident or develop a serious illness. Only Affordable Care Act compliant plans have a guaranteed out-of-pocket maximum, and with any other plan, you risk facing massive bills. But a good option for saving a little money might be to revisit your auto and homeowners policies to see if you can bring the price down by raising your deductibles without reducing your overall coverage, or just shop them around. I mean, on other shows, we've had Lemonade here as our sponsor. Take a look at Lemonade, stackingbenjamins.com/lemonade. Go to your local agent who can run it through 50 different things. Progressive. If you go to Progressive, you'll run it through a bunch of their competitors just with one stop. Love all of those options. And I also love the option of not skimping on your big major insurances. And you see people do this. The people that get rid of insurances, the people that can't afford to. And I find that incredibly frustrating when I see it becomes like a gambler mentality. You know, if things just go right for me for the next 3 or 4 months, I'm going to be okay. So I'm going to cut this insurance and just gamble just a little. Doesn't end well. I feel like who's Dr. Phil? How's that working for you? Usually not very good. All right. Next, she says to make your cash work harder for you by getting a higher interest rate. That's marginal. You're going to make another $7 that way. Number 7, use this as a buying opportunity if you can. That's fantastic. So if you earn extra money, hey, try to buy more to beef it up for the next time so you're not as far in trouble. Good stuff here from Tanya at Market Watch. I'll link to this on my Twitter feed over at Average Joe Money. Love those ideas. And in our Facebook page, our Facebook group, Karen says, glad I paid my Fidelity Visa bill right before the recent drop so I don't have to look at accounts for a few weeks. Yeah, that's nice, Karen. Just turn it off, put the blinders on, and don't look at all. Than said, Lemonade also checks different life insurance policies, or does Magnify Money do it? Nope. I don't think either one of those does. Lemonade is just a quick quote. It takes about 90 seconds. It literally took me no time to get it. I think it took me quicker than 90 seconds. They advertised 90 seconds, Than. It took me no time. Richard said, yes, buy in time for the market. Yes. And by the way, if you're going to buy, don't think that buying the dip always pays out quickly. I met people, buying the dip in 2000 and still buying the dip in 2001. And some people buying the dip started saying, I'm throwing, quote, good money after bad. And they stopped doing it. And man, had they continued that strategy all the way through, it would have been fantastic. So don't think that dip's going to be a short-term dip. But I love the way Richard thinks about it. All right, great stuff there, guys. Love that second piece. In just a second, we're going to tie these two together. How the heck are we going to tie together subprime mortgages and early retirees trying to not get killed by this down stock market? We're going to have that in just a second. But first, I want to talk just briefly about what's going to go on in Detroit in about, a week and a half now. We're headed to Detroit on October 24th. The show starts at 7 p.m. at Go Comedy Improv Theater. By the way, you can get all this at stackingbenjamins.com/tour. You can look it up. You can buy tickets. Tickets are only $10. Seth Ressler and the Debrief podcast are going to open for us. I got to tell you, the acts that have opened for us in both cities so far have brought it. Joel Goldberg talked to the president of the Negro Leagues Baseball Museum, and it was one of the most fascinating conversations that I've seen on any podcast, let alone a live podcast from a comedy club. Fantastic. And Chris Browning and Popcorn Finance in Orlando, amazing. Had the whole crowd laughing, had a great time. Seth Ressler and the Debrief podcast, already phenomenal podcast with a great reputation. And I can't believe they're going to be part of our show. So that's going to be good. And then in the main show, not only are we going to have people like Kat Alford, and who writes about all kinds of family money stuff, and Andy Hill from Marriage, Kids, and Money will be with us. We're also going to have my buddy Dan Posdel, who was on the show talking about life from the financial planner's point of view. Like, what's your financial planner think about you? He'll be with us. Shannon Cason, who's on The Moth, who's on Snap Judgment. He's on all these great storytelling podcasts. And if you've never seen live storytelling, you're going to see it. We haven't yet done live storytelling on any of our shows, and we're going to do it in Detroit. StackyBenjamins.com/tour for more. All right, let's end this, guys, with our big deal. So our first headline, we talked about 0 down subprime mortgages, and I went, oh boy, what could possibly go wrong here? And then we find that this group has been doing this for a long time and has had 0 defaults. And the difference, I believe, is education. And when it comes to your financial health, educating yourself is the key. And then early retirees in a bouncy market. Tanya Hester writes over at Market Watch, the key there, don't sell. And if you have to sell, start with the lowest risk stuff first, and then go to the more bouncy stuff. I like using that term, bouncy. Makes this down market sound fun, doesn't it? But the big idea here is this. You know, a lot of people rely on others. And I'm a guy that was a financial planner, and I still believe that having a financial planner in your corner, like you'd have a diet coach or have somebody help you with your taxes or whatever, I think that can be a great thing. It should be a very smart person, though, who helps you make smarter decisions. It's not people that takes the education away from you. You can't just delegate away your financial responsibility, because it drives everything else in your life. Even if you don't think you like this stuff, delegating it away, I think, is a huge mistake. The big idea, I think, from the first piece is to rely on you. Rely on your ability to get educated about mortgages, and look at what happens. People with not a lot of resources who have had bad problems with credit in the past get some education. They don't default on their mortgage. And it's the same way when you're an early retiree. If you're an early retiree, knowing which stocks to sell first, knowing how to hold on to your insurances, education again for the win, but relying on you and your ability to maybe cut expenses or your ability to go out and earn another dollar. Relying on you versus, I think there's a big difference between delegating and abdicating. Delegating means that you're handing it to somebody, but you know exactly what you're handing them, and you also can oversee the project. Abdicating means I throw it at somebody, I tell them to do it, and I walk away. Wash my hands of it. I don't want anything to do with it. You can't abdicate. You can delegate. And I think we're going to leave it there. Hey, thanks everybody for hanging out today on Facebook. Thanks for hanging out at home. Go Stack some Benjamins. We'll see you back here again next time at Money in the Morning.
Money in the Morning is created by Joe Saul-Sehy and comes to your ears because of the collective genius of our producer, Richie Rutter-Reese, engineer, Caden Thompson, and a pack of very well-trained ferrets here in the basement. You'll find links to all of our headlines featured on today's show in Joe's Twitter feed at @AverageJoeMoney. I know you already know this too, but Money in the Morning is for entertainment purposes only, and you shouldn't act on anything recommended by a bunch of entertainers in a basement without first consulting with your financial advisor, and second, having your head examined. Have a headline you'd like us to discuss? Send them to Joe at StackingBenjamins.com or put them on our Stacking Benjamins Basement closed Facebook group. This show is copyright 2018 Stacking Benjamins LLC, all rights reserved. I'm Joe's mom's neighbor Doug, and I reserve the right to always say, we'll see you next time back here on Money in the Morning.